let's cut the suspense. This gold sell-off is far from over. When gold was peaking at 5,500, the entire internet was drunk on a de-dollarization narrative. And now it's plunged below 4,300. The herd is panicking that treasury yields are going to crush gold. The brutal truth behind why the vast majority of retail traders are bleeding capital right now, they're fatally confusing a long-term bullish macro strategy with short-term bearish tactical volatility. You cannot use a decade-long macro thesis to justify tonight's scalping, nor should you let a 1-hour flash crash shatter a 10-year conviction, right? Mix this up, and the market will mercilessly whipsaw you into oblivion. If you've been following my channel, I don't sugarcoat things. I've been relentlessly warning you about the downside risk brewing in gold, exactly as scripted. Last night's non-farm payrolls delivered a fatal headshot to both gold and silver. Not only did the headline job numbers obliterate expectations, but the previous 2 months were quietly revised upward. The smart money read between the lines instantly. If the US economy is this robust, why would the Fed ever rush to cut rates? And consequently, treasury yields reap higher. Wall Street completely wiped IPO rate cut off the table and started quietly pricing in a sheer terror of further hikes. This violent repricing of interest rate dictated today's bloody price action. Asia dumped and Europe aggressively followed their that predictable range-bound rhythm of Asia dips, Euro reaps, US consolidate the stat. What we're facing now is a relentless 24/7 one-way liquidation. This reveals a massive behind-the-scenes stampede. Over leverage bulls are getting liquidated, and hot money is indiscriminately slashing positions to survive. And if you think the bleeding stopped here, you're dangerously naive. The true catalyst drops on Wednesday with the May CPI data. Institutional sentiment heading into the spring is incredibly dark. If inflation proves sticky and research past consensus, the Fed's hawkish playbook will shift into overdrive. And the second treasury will spike again, the gold market will face an even more savage round of capitulation. And the nightmare doesn't end there. Thursday's PPI data is lurking right behind. Historically, this back-to-back macro data combo is the perfect setup for Wall Street infamous pig bantering trap. They will hijack the data to manufacture a fake rally on day one, only to violently flip the script and dump their bags on retail traders on day two. And therefore, in a weak engineer for extreme volatility and vicious stop hunting, you need a reality check. Are you an investor or are you a gambler? If you're a long-term spot holder banking on de-dollarization, great power competition, and structural inflation, then intraday noise of NFP, CPI, and yields is entirely irrelevant to your thesis. Look behind the curtain. Sovereign central banks are aggressively front-running the market. They scoop up 160k ounces in March, 260 in April, and ram into with 320k ounce in May. The national team is effectively providing a hard floor for long-term bulls with physical cash. And for you, engineer washouts like this are a gift, carving out a deep margin of safety. But if you're trading short-term with leverage, stop drinking the macro Kool-Aid. The short game is purely about liquidity hunting. The market is saturated with bearish catalysts. If you insist on catching a falling knife for a quick bounce, you better have a ruthless stop loss. And my personal execution plan. Follow the liquidity and short the rallies. Bottom fishing here is financial suicide. Gold has shattered the EMA 200 and officially entered a technical bear market. The key overhead supply zone is sitting near 4,350. Any dead cat bounce to this level is a premium shorting opportunity. I am setting a hard stop at 4,400 and aiming for a capitulation target around 4,200. The risk reward ratio is absolutely lethal. As always, this is just my personal analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content. Bye.